Venture capital is not a solo game. It's a network-driven industry where investors rely on syndication, co-investments, and strategic partnerships to maximize deal flow, share risk, and support portfolio companies. The most successful VCs don't just pick great startups, they build strong relationships with other investors, from angel investors and early-stage VCs to late-stage funds and corporate investors. For investors, knowing how to collaborate, when to co-invest, and how to build long-term trust with other VCs is just as important as evaluating startups. Venture capital is an inherently high-risk asset class where success often depends on access to the right opportunities, strategic partnerships, and risk-sharing mechanisms. One of the most effective ways for venture firms to strengthen their position is by building relationships with other investors. These partnerships can provide significant advantages, helping firms access better deals, manage risk, and support long-term portfolio growth. By collaborating with other investors, VC firms increase their chances of being invited into competitive funding rounds. Some of the best deals are often closed among a trusted network of investors, where firms with strong reputations gain preferential access to high-potential startups. Through co-investing, venture firms can spread exposure across multiple funds, sharing the financial risk associated with early-stage investments while maintaining a diversified portfolio. This collaborative approach allows firms to take part in high-value opportunities without bearing the full burden of capital commitment. Beyond deal flow and risk sharing, strategic relationships also enhance portfolio support. Investors within the same network can help companies secure follow-on funding, introduce them to potential acquisition partners, and facilitate smoother exits. Firms that collaborate closely with sector-focused investors can gain deeper insights into industry trends, helping them make more informed decisions when assessing new opportunities. A strong example of this dynamic is when Sequoia Capital and Accel co-invest in a startup. Each firm brings its own network of founders, industry experts, and market connections, significantly improving the startup's chances of success. By leveraging complementary strengths, these investors provide not just capital, but also strategic guidance, mentorship, and access to valuable business opportunities. In an increasingly competitive VC landscape, the firms that prioritize strong investor relationships are often the ones that gain the most leverage. By partnering with the right co-investors, funds can navigate risk more effectively, secure high-quality deal flow, and ultimately drive better outcomes for both their LPs and portfolio companies. VCs collaborate in different ways, each with its own strategic benefits. One approach is co-investing in deals through syndication, where multiple investors share the opportunity. This allows startups to secure more funding while investors diversify their exposure. Another approach is follow-on investment strategies, where early-stage VCs introduce their best portfolio companies to growth and late-stage investors. This ensures startups can raise subsequent rounds and scale. VCs also form partnerships with sector-focused investors, such as deep tech, fintech, or biotech specialists. These partnerships help generalist funds de-risk investments by co-investing with experts who understand the nuances of specific industries. Venture capital is a long-term game where trust and credibility determine access to top deals and partnerships. Successful investors go beyond capital, offering strategic insights, operational expertise, and key introductions that help startups grow. Those who actively support their portfolio companies build stronger reputations and deepen ties with other investors. Maintaining fairness is equally important. Respecting pro rata rights, ensuring transparent communication, and being a reliable partner in funding rounds strengthen investor trust. A strong reputation leads to better co-investment opportunities and access to high-quality deals. Expanding networks requires ongoing effort. Attending investor events, joining syndicates, and maintaining relationships with top VCs are essential for staying connected. Many of the best partnerships are formed through informal meetings and industry collaborations. In the end, venture capital is about more than just money. It's about trust, reputation, and long-term relationships that drive success. Strategic investor relationships shape entire startup ecosystems. For VC firms, strong partnerships provide access to better deal flow, enhance startup support, and improve exit opportunities. For founders, having a well-connected investor can help secure top-tier investors in later rounds, open doors to customers, and strengthen strategic partnerships. At its core, venture capital is a relationship-driven business. The best investors are not just great at picking startups, they're great at building lasting partnerships with other investors. Venture capital is a relationship-driven industry where collaboration with other investors is essential for securing top deals, managing risk, and supporting startups. Through syndication, co-investments, and sector partnerships, VCs gain access to high-value opportunities and ensure long-term portfolio growth. Trust and reputation play a critical role as investors who actively support their startups and maintain transparent relationships secure better co-investment opportunities and long-term success. Ultimately, VC is not just about capital, it's about building lasting partnerships that drive innovation and strong returns.